We're at extremely high valuations. What I said in January also was the one thing that's weird about it, as high as the valuation is, it's actually cheap to bonds. And that was the biggest case. The biggest case for stocks is that they're cheap to bonds. They still are cheap to bonds because the bond yield is so ridiculously low. And you also have the Fed doing their quantitative easing, and it still remains the case that there is almost a constant, so it's almost like a law of physics, that if you take the Fed's balance sheet and divide it by the market cap of the S&P 500, it seems to be a constant. And this is true going back like 10 years. So the Fed continues with their bond buying, and they continue to suppress interest rates, and that's been supporting the stock market. Obviously, the stimulus has been very substantial support for the stock market as well. But when you think about it, the stimulus to the consumer is really the same, sort of the same thing as the Fed's bond buying program. At least it's facilitated by it. So the stock market hangs in there. The problem is that we're not sure what's happening with the stimulus, and the Fed is getting it's getting difficult for the Fed to talk about this inflation situation as being temporary or transitory, as they like to say. I mean, the PPI is at a huge number. Import prices came out today up 11%. We all know the CPI came up at 5.4. I mean, these are numbers that remind me of the 1970s. In fact, a lot of things remind me of the 1970s. You know, we're just pulling out of a failed war in Afghanistan where we basically fought to a stalemate. It kind of reminds me of the 70s and Vietnam. And we had guns and butter that led to inflation in the 70s and the late 60s and the 70s into even the early 80s. And we certainly have guns, butter, student loan cancellation, free unemployment benefits, and everything else. So we're going kind of full tilt. That keeps the stock market at high levels, also keeps commodities at high levels, and it keeps bond yields suppressed at levels that are ridiculously low versus the inflation rate. It seems to me, on price action we've seen recently, that the Fed seems to want the 30-year to be capped at around 2%, which is lower than I expected. So we can talk about that if you like, but I'll stop there for the moment.